Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 a.m. in the UAE, at least, probably a little earlier elsewhere. And so we're grateful for our European-based colleagues for joining us this morning with Brent crude oil trading at the doorstep of $60 a barrel at 60.82. Latest news of as I get up quite early in the morning to myself to check out where all the headlines are. And I've never seen a time where a president or one singular person just literally doesn't just dominate the headline above the fold, but literally every other headline on the front page. And we are in the world of Trump. There's no doubt about it. But the latest one being a renewed outlook for talks between his old buddy Putin, and that has given again the idea that perhaps a deal can be done on Ukraine. Let's kick off this morning with Adi Imsirovic, Director, Surrey Clean Energy and a Senior Associate at the CSIS. Adi, your thoughts, on the idea that we've had earlier this week, sort of ideas that Trump had done a deal with Modi over India and stop importing Russian oil. And the Indians said, ooh, what conversation? We weren't on that call. And now we've got this idea of talks with Putin. Your views on that and its ramifications for the oil markets?
Well, good morning. Thank you, Sean. We're quite used by now to the fact that Trump likes to do his victory laps before he's even gone into battle. So, the same story with Modi, the same story with Putin, and I guess that there was a phone call between Modi
But
and
ultimately,
Putin.
the market keeps following him down those rabbit holes, don't they? I mean,
Well, I'll tell you what, Sean, I'm really glad I'm not trading at the moment. I'm really glad. It's a horrible, horrible market,
you're
totally
really
driven by
depressed you
headlines.
weren't trading 2 years ago. Now it's one to be glad about.
So it's really hard, and you can actually see it in the results of trading companies at the moment. We've seen Gunvor results, and I think soon we'll see the results of Vitol, Trafigura, and so on. Generally, BP, Shell trading teams also underperformed. It's very, very hard. It's good to trade volatility, but it has to be some sort of meaning behind that volatility, some logic behind the positions that you put on. When you have this random unpredictable president, who basically makes decisions on a whim. This is very, very typical of a real estate developer. He's just going to meet a guy and he thinks he can hammer out a deal. There's no preparation. There's no leverage. There's no kind of logic behind it. He just thinks it will somehow happen. In
If
some
we look
cases, he can.
behind the sort of dominoes on the other side, if you like, is there? I mean, the developments in Gaza and inshallah they hold. It seemed forever to be just caught in a quagmire, and then maybe at some point there's just exhaustion in all the corridors of power where it needs to be. Is there any signs of that in Kiev, in Brussels, in Moscow that regardless of Trumpian sort of unpredictability, but just the playing field is now signaling that just, enough, we're done.
Well, yeah, with Trump, better lucky than smart, and he may eventually be lucky because there is a lot of exhaustion on all sides at the moment. We've just recently had a Russian offensive that was repelled by Kiev. Russia is losing a lot of soldiers all the time. There is a lot of exhaustion on all sides at the moment, and I think Putin will be quite happy to sign a peace deal on his terms. Of course, he is absolutely essential for him to keep Crimea and part of Donbass, which is very resource wealthy. And if he could do that, I'm sure he would sign a deal. The danger is that actually Trump, just in order to show that he can make a peace deal, actually just agree something unilaterally on behalf of Ukraine and of course the rest of Europe. Of course, that wouldn't hold at all, but that there is quite a possibility. So at the moment, quite frankly, I don't see a chance for any peace deal. I wish I could. It would be great if something could be achieved. People are dying every day, but this situation is going on and creating more volatility in the market.
Let's go to London across the street to Paul Hicken, Chief Economist and Editor-in-Chief of Petroleum Economist. In either case, Paul, we've always sort of talked through the year that the geopolitical stresses of Ukraine and Gaza, as traumatic as they are for the people on the ground, they didn't have ripple ramifications for the energy markets until the tide goes out and there's a sort of downward draft on the oil prices as some of these events look like they move towards resolution, and then when they don't, the oil price sort of drifts back up again. Your thoughts on the talks for the outlook, for not so much about whether they're successful or not and meaningful or not, as Adi just commented, but whether they have relevance for the oil markets or not, if indeed in either direction this deal in Russia can be done.
Well, I think in terms, I thank Sean for having me back on. I think in terms of Russia, I think the any agreement will ultimately, first and foremost, is about the refining side, which has been massively hit right now in the last couple of months, which is a new development really in that sort of spike. And while
Being hit as in literally hit by drone bombs
yeah,
onto
by the drone. So if there's some resolution, then from a oil market's perspective, first and foremost, well, that's, we see it tightening in the diesel side, the gasoline side markets because, the lack of products coming through. And we see more crude coming out from Russia to a degree, although they're pretty maxed out on their production side, really. So you say that would be the first foremost because the markets are tightening and that's going to catch up on one side. It's a funny market where you've got products are tightening, but actually there's all this talk of an oversupply and there's, massive supply glut. So I think that's the first thing to think about if we're going to some agreement. But on a broader trend and this kind of idea around trades and sanctions, well, it is grit in the global markets wheels, but at the same time, and we've seen that where prices have dropped from what $80 plus at the start of the year to now like $20. So it has been a kind of attritional downward move over time, but at the same
But we
time,
seem to have broken now out of that $65 Goldilocks handle where the market was quite firmly, and we're still on the average for the year above 65 on Brent, but we seem to have broken down to a new range, at least testing a new lower range in the low 60s. Is that, do you think, a structural shift now, or will we migrate back to 65? Is there something structurally changed to break us away from that $65 handle?
That's a great follow-up question, Sean. And I think we seem to be breaking down each time. Or 70, I think, was kind of the floor, and then sort of OPEC started to bring barrels back in the sort of summertime. But that was sort of mitigated by China's stop buying. So that you had that kind of sort of very slowly. And I think for all the talk of a glut and the risks which everyone seems to be talking about, this thing, a very sort of concerted narrative that we're going to continue going down. This glut's going to emerge in the fourth quarter, which we're already into the first quarter of next year, and the price are going to break down well below 60. But I think there's a few cautionary tales around that, which stocks are already low. China could still continue its buying, and there's not many more barrels to come from OPEC. Only Saudi Arabia and UAE, and the rest are all maxed out. So I think even that, and as we get to 60, this price point. It's the on the supply side. It's very important to remember that US shale is feeling the pinch point. You know, I know we talk about 65, it feels a pinch point. At 60, at break even, it feels a pinch point. It's quite complex, the broad set of shale mix. You can't say every breaking is different, but at 60, 55, it starts to continue to really feel those pain points. At some point,
And that
that's going to
certainly
turn.
puts WTI well in the 50s. Arne
Yeah.
Lohmann Rasmussen, Chief Analyst and Head of Research at Global Risk Management, sitting there in Copenhagen. You're literally now part of this sort of face-off with Russia, would appear, with random drones coming in and flying over your airports in Denmark. Same question to you as I had to Adi. Do you feel in the mood music, in the bars of Copenhagen's canals, that things are fun, that there is a shift, that maybe this time is different and a deal has to be finally done on Ukraine? Or is this just another kind of false dawn?
I think it's when I saw the news yesterday, it felt a bit like Groundhog Day, if you remember that movie.
Yeah,
You know,
of course,
where
Bill Murray.
Yeah, he wakes up every day, it's the same story. Go back
Although
to Alaska.
drones over Copenhagen airport feel like
And that's
turning up the ante a bit.
No, that's different. And the escalation is for real. That is not Groundhog Day. But the idea that Trump is not going to meet with Putin in Budapest, and he's not going to sort this out. This is a Groundhog Day compared to what we saw in Alaska back in August. It's not going to bring us anywhere. And I think it's really, really sad that he stopped this, because I think, as you said, Paul, we actually had some pressure on Putin now. The refineries are down. We actually saw some of the first protests and so on in Moscow, and now he gives him leeway, gives him room again, and that's why the market is down this morning, because you're pricing out the last risk premium. Nobody believes that he will be tough on India now. Nobody really believes that Ukraine will get any tomahawks, so they can really take some more refineries out in Russia to put the last pressure on Russia. This is just exactly as in Alaska. It will go on. There'll be best buddies in Budapest. EU will have no way to do the 19 sanction packets, because Hungary will be eager to show that they will not support that, and Putin will continue to bomb in Ukraine, and we're back to square one. It's a missed opportunity, in my view, that we saw last night, and that is really, really sad. And of course, the market is reacting to this, because there will be no further sanctions for a time being on Russia now. India will continue to buy Russian oil, and so on. So of course we're moving lower. And on respect of the price, remember, we often see that oil is overshooting, but it can certainly also undershoot. And that may be what we are in for now, because I very much agree with Paul. There are a lot of factors out there that are sort of creating a floor below prices, build-in Chinese inventories, US shale oil production will be under pressure and so on, but the market can undershoot as well as it can overshoot, and we may be in for a undershoot now. I think it's a great opportunity, and that's also what we tell our clients to actually, we trade with corporates that could hedge their energy exposure the next couple of months or even weeks here. We were laying the foundation for higher prices later, but the market can very well undershoot. But seen from Copenhagen, this was not seen from the Baltics. This was not a good development last night. There's no way. We just have to continue build our defense and so on. We spent a lot of money on that. There's no way around that.
Adi, although it's not your immediate wheelhouse, but it's one I think that I certainly have been watching for some clarity of where the world is, despite all this fog. Gold rallies to 4,000, above 4,300 today. And as the reporting is, generally, I suppose when any market goes up, it says best week in 17 years. I'm not sure there's anything best or great about the fact that the budgie in the coal mine is screaming gold at $4,300. Your thoughts on that and what it tells you about the wider market and economic outlook?
Well, that's a great one, Sean. Geopolitics and macro situation. In regards to macro situation, it's very obvious that oil ceased to be the commodity of choice for hedging inflation. it used to be. If you actually, I'm not bullish at all. I haven't been bullish for quite some time, but I actually don't think oil price is all that high. I think it's in real terms extremely low. If you look at the oil price in terms of gold, silver, copper, and pretty much any other commodity, it's extremely, extremely cheap already. So the other thing is the fact that gold, or canary in the gold mine, as you say, is gold mine.
Well, when you look
is
at the oil price before gold went on its rally 2, 3 years ago, it was nearly a third of its current value, and oil was double its current value. So
correct.
compared to gold, oil is worthless.
The number of geopolitical factors that can play into this is just enormous. Let me just point out probably one that sort of wasn't mentioned here, it wasn't in your news. For example, the former head of IMF, Geeta Gopinath, is basically just wrote a piece in the last Economist on an invitation. And she basically said that, quite clearly the market is overpriced, that we're seeing a massive
You're talking
bubble.
about the financial markets, equities,
Financial
and so on.
markets. We're talking about S&P and all the other, especially Magnificent Seven stocks, tech stocks, and so on. And we have Schiller's price earnings index at some of the highest levels since the dot-com crisis. We're almost there. Okay. And the danger, according to her, is that this time around, we remember the fallout of the dot-com. I mean, especially you and I, probably not the younger listeners. It was massive.
What?
Absolutely. And it was massive. So basically what she's warning right now is that I think probably some $35 trillion of wealth in the world could actually be wiped out in case of a crash. America, United States would be particularly obviously affected, but so would everyone else, because in the past, what used to happen, dot-com era, you invest into US stocks. Even when there was a crash, usually the run to safety would support the dollar. So for foreign investors, that dollar would cushion part of their blow. Right now, dollar is under a lot of pressure because of Trump policies as well.
And by the weak dollar, you're seeing more flows into the S&P 500.
And that's a very good point again. Segue back to oil. That it's extraordinary to have this weak dollar and actually weak oil price.
So, Paul, where does OPEC Plus go with all this? 6-7 months now into an increased cycle, every month a few more barrels, at least physical and on paper quotas increasing. Does this sustain if oil continues this drift downwards and into the 50s?
Well, that's a great question, Sean, as well. It's certainly we've seen.
I've got a box full of them here.
You've already seen a softening. They tested the market, arguably tested the market with the release of like 500,000 barrels a day a return, and they saw how the market reacted there, and they've gone much more modest now. So is it going to be these kind of smaller increases, or is it even going to be a pause if prices go lower? It's very difficult to tell. You would think.
I mean, you said it yourself. Do they even have the capacity to keep going regardless of the price, or it starts to sound like a false sort of narrative? We're going to increase again. Yeah, who exactly is going to increase?
Yeah, because at the moment, and this all comes down to where price is going to go, really. Because at the moment, up to this point, there's always been this argument that it's balancing the market, that there's still enough physical supply, and to some degree, that was borne out. There was certainly some argument you could be made that OPEC was still balancing the market, that they don't mind prices in the 60 to 70 range, and that it helped sort of cleanse the palate from all these sort of non-compliers. But arguably OPEC's endgame wants to get at least down to the market management of its group, rather than these voluntary production cuts. But it may take longer to get there if prices go lower for sure. And they might have to suck it up again, which would be still a source of tension within the group for certain if they have to keep going with this, but they've done it before and they'll do it again. I would just say on Sean, on Addy's point as well, I think that tech bubble, the question around the tech bubble, the AI tech bubble is a very important point going forward as well. I think, we could be back to the old Goldman Sachs line of revenge of the old economy, which means we are underweight on energy, and energy is physical, is a physical market. We need energy more than, as much as we talk about gold or tech. Energy is so important, and at the moment we've been in a position of we have had no shortages, but in times of shortage, and not just talking about oil here, but just shortages generally, that there could be a wake-up call for the market at some point, if that happens.
Arne, if you might just weigh in on that. Obviously, in the mix here, we have the latest noise around the Fed, what they're going to do next, and growing noise around a 50 basis point cut. With all of this sort of obvious drama, the IMF are telling us in recent meetings that actually the world economy has been quite resilient and is doing all right. So don't get distracted by all of the noisy headlines. As the global, head of research, global risk management, how do you share more IMF kind of view that actually things aren't that bad despite the headlines, or are you with the cut rates as quick as you can because they were going off a cliff here?
No, the economy is not that bad. It's weakening in the US. The labor market is weakening, but the inflation pressure will continue to rise. And I think we underestimate that risk, and certainly the central bank is aware of this, but they are under a immense pressure. That the Trump administration says that there will not going to be any inflation pressure from these tariffs, and so they'll be eaten by other countries and the importers, exporters, or whatever. Not the consumer. Of course, over time it will feed into consumer prices. I noticed we're quite big in the shipping industry. There's some important negotiation going on at the moment in London, the so-called IMO, International Maritime Organization. You're basically trying to build a global carbon system and phase in of use of renewable fuels in the shipping industry. And the US is really against this, saying that this tax will lead to higher consumer prices. It's a bit funny that exactly this tax will lead to higher consumer prices, but tariffs will not. But I'm sorry for being derailed here. No,
but that's a very important reminder, because inevitably that does bring a critical piece into the global shipping space in terms of tackling that carbon issue, and where there does become a carbon tax across the world, which inevitably many would argue efficient markets need at this point. The absence of it is distorting. Let's go to the survey question and get a view in the room, and where we started our conversation, which is U.S.-Russian peace talks on Ukraine could push crude oil prices into the 50s over coming weeks, ahead of a summit that Trump has told us will take place in a few weeks. It seems, again, on the sidelines of this Asia-Pacific conference. He's due to meet Xi and solve the China-US trade war, and he's going to meet Putin and solve the Russia-Ukraine war, and then notch that up to 10 knots on his belt. And surely the Nobel Committee cannot ignore him at that point. Joking aside, but nonetheless, is this the kind of this weighting of this idea of resolving Russia going to be the sort of hair that breaks the camel's back on a fairly resilient oil market, which is already carrying a lot of weights on its weak shoulder, whether it be most notably OPEC plus production increases, but a weakening demand outlook in US and China, and yet the oil price has held. The average for the year is 65. But is this finally, some of us were in Singapore for APEC, and there the call was that oil prices would drop $10 through the fourth quarter. That seemed a bit of a big call at the time, but now we're not getting far off that if indeed this trend line continues. So views in the room on dropping into the 50s with this added weight of a summit between Putin and Trump. Adi, looking forward, as you're saying, thank God you're not trading now. What of all the things that one has to look at? I mean, there used to be a saying, close your books in May and come back in October or something like that. Uh, where does that go through to the end of the year when traders look to close their books? Will they close them earlier and just get off the table? Your thoughts on what would be the sort of North Star for risk and appetite into this final months?
Well, I think the key indicator for a lot of traders will be the forward price curve and move towards contango. Dated at the front end is already in contango. Next year from February, the market is Brent market is in contango. You'd be looking to lock in some of that contango and fix some storage. I don't disagree with what Paul was saying, but at the very, very front end, there's a lot of oil. There's a wall of oil coming towards us, and that will have to go somewhere. Now, that's not necessarily something that will push oil into 50s. I think what's more likely to put oil into 50s, if it happens, would be some macro situation. And I think Arne raised a very important point here, is that there's a lot of pressure on one hand, you've got huge debt problem everywhere. United States, UK, Europe, everywhere. On the other hand, pressure in the Fed, and we know the Fed is the key for everyone else to drop the rates. Inflation is inevitable, okay, on top of tariffs and everything else. So we've got inflation problem. We've got a problem of overvaluation of stocks, particularly tech stocks. I think that these are the canaries in the mine that we're going to watch and basically see probably a major correction. Now, return to the old economy, what Paul said, perhaps eventually.
You used the word the revenge of the oil economy.
Revenge, sorry, perhaps eventually, but I'll tell you what, if there is a bad macro, the stock market collapse, oil is not going to rally, okay? And eventually, I would agree with Paul, because in the next 3 or 4 years' time, energy transition is going to come only when oil is relatively expensive to alternatives, relatively, whatever that means. So oil will have to be expensive through lack of investment. So whatever the CEO of Aramco is saying is actually a normal thing in an energy transition. They invest less into resources that are just becoming uncompetitive. And that's why people are not investing.
Paul, just picking up on that, I wanted to ask you, I'm not sure if you were at the Energy Intelligence Forum this week in London. A lot of the big global CEOs were there giving us their views. Any big takeaways to take note? Obviously, the Aramco CEO got a lot of coverage with his comments about the point of lack of investment. In a lot of ways, talking up their own book, but ultimately, there is a true narrative there. As we had this year, the outlook for a surplus was going to come and depress the price. It hasn't. Now the new outlook is the opposite for the end of next year.
Yeah, I was there, Sean, and I actually saw Adi there actually as well. We shared a coffee. I would say a couple of key takeaways, which was, I think there was a few of the big oil executives were saying that the market is not tight right now. I mean, the market's the market's still not got a glut right now. Sorry, there's no excess physical supply right now in the market. So, and like, I agree with Adi that the balances do look bad coming in the next few months, and certainly all the traders were there, Trafi and Vitol, and they were all talking the same line about prices will drop to in the 60s, that there is this sort of oversupply. There's a very strong narrative. Whether you get down to the 55, 50 mark or what depends on many factors, like we were saying. But I also think one thing that was probably is being slightly overlooked as well, which is that if we have all this oil in the market, and then what happens? Because what's going to be in the situation is that two things. One, there won't be much OPEC spare capacity left, and that leaves the market vulnerable to geopolitical risk in 2026, which could be potentially huge as well, even with lots of oil swirling around the market. And secondly, where's this leave China in terms of its buying behavior? Because if it continues buying, China becomes a very big strategic, it's already a big strategic player, but we sort of talk of China as kind of the rest of energy. But in oil, it's becoming this development, which we have seen before, this market management technically of China. We've seen this happen before, and it's using its strategic buying in a way that in a time when US SPR has actually been depleted. So these kind of interesting developments going into the end of this year and 2026, regardless of that oil swirling around.
Yeah, certainly China's, you would think their pattern, everything else aside, $60 Brent would seem to be a buy signal for them as it has been in the past. Arn, disagree in the room here about peace talks having a downward pressure of Brent into the 50s. What do you think is going to be directing if indeed we do have a trigger into a lower price range, or are we going to trend back up to the 65 handle that we've been at for quite some time?
Given that we are trading, I think below 61 this morning, the probability is quite high that we will move to the 50s. That's pure mathematics.
Yeah.
That's the first thing. A trigger.
An intraday trade may have one or two trades could have already done that.
A fat finger could at least. I think we have seen. I think we are starting to see signs that the oil glut is arriving. We have these oil at water is exploding. If we include the Chinese inventories, there are definitely a global inventory build at the moment. I think it was you, Paul, that talked about the forward curve is pricing in the contango. I'm actually quite interested in the contango because we may need a more contango this time to actually kickstart the inventory building, because the funding of holding oil is much higher now than it was during the pandemic. Remember back then, dollar rates were basically zero. Now dollar rates for companies that do this may be 5-6%. So they basically need a higher contango to store oil, to start hiring tanker rates are also higher. That's a new factor here that may indicate that actually the spot could come under further pressure, and then we will have more contango in the market. But certainly something to look further into. But a trigger for lower prices is of course that we actually see OECD inventories starting to move higher. We get a confirmation that these oil and water is not just a flux in data and so on. The International Energy Agency seem to believe that there are actually a lot of oil floating around out there. And a stabilizing factor is basically that the OPEC calls off the production hikes, and I think that is not unlikely to happen over the next couple of months.
Okay, well, we'll wrap it up there with Brent crude oil trading, as we said, a little bit down again. It's looking like we're getting into 60.83. Whether we'll close below 60 on Brent, we've tested it twice in the last 2 weeks. Will it break through? Thank you so much. As always, great to have three of the best in the business at the table on a Friday before we can go off to the weekend and think about all these things. Adi Imsirovic in London, Paul Hicken also in London, and Arn Loumen Rasmussen up in Copenhagen. Have a great weekend, everybody, and thanks for your time. All the best.
Thank you.
Thanks, everyone.